I'm with Gary Reynolds, Chief Investment Officer, after delivering client seminars across the country to answer the questions that you put to the panel throughout the seminars. Gary, hi. I have a stream of questions for you here. First of all, we've got one from Andrew. Thank you, Andrew. The LSE, London Stock Exchange, has seen 1.9 trillion in outflows since 2000. Does courtiers think this vicious cycle has turned?
Possibly. The reason you're getting money going out is because America has got so much depth to its stock market. And if you're going to float a business, if you're going to have an initial public offering, you want there to be lots of money available to chase your stock. As Jake said in the seminar, you could the value of Apple would buy you the biggest 350 companies in the UK. But you have to understand that the US is a mega market. It dwarfs everything else globally. So it's a lovely question. It almost implies, could we compete with Wall Street and the NASDAQ and these big American bourses? And we can't because their economy is so big. But we're still big outside of the US. We're still one of the major markets in the world. And these things tend to go through phases. So when there's a move away from the very tech-orientated companies, we're possibly going to see a return of interest to the UK market, which doesn't tend to have lots of those techie companies on it.
So sticking to the US, question from Graham. If the US stock market's returned 232% over the last 10 years, why has the Courtiers Growth Fund only returned 129% over the same period?
Because we're not a US fund. US has been the best major market over the last 10 years. We're a multi-asset fund that's got to have diversification of risk. We hold a range of assets, infrastructure, bonds, a bit of cash, yes, sure, equities. But you know, we may have, what was it, 129?
Yeah.
But I think you'll find the FTSE only returned about 90. So I could reverse that and say I'm a UK fund, we're multi-asset, and yet we've outperformed the FTSE over that period. I think if you look at us within our peer group over that 10-year period against funds which are diversifying risk, we take nothing like the level of risk you would take if you invested purely in the S&P 500. Or the NASDAQ, the big US stock markets. So we are much more broadly diversified than that. But if you compare us then within our peer group, we do extraordinarily well. So we have certainly delivered on the mandates for the last 10 years.
So again, from Graham, Gary, over the last 3 years, why has there been no growth in the Courtiers Growth Fund?
Well, there has been growth in the Growth Fund. I mean, I haven't got the figures off the top of my head, but that's in double digits over 3 years. It was wobbling a little bit at the start of November this year, but we're up year to date. In fact, most of the funds are now up in the year. So, you know, it's doing all right. The problem is if you compare it to the big tech companies, your Nvidias and Apples and Metas and Microsofts.
Magnificent Seven.
Yeah, it's not going to do as well as those when they are flying. It'll do a lot better than them than when they're falling, as happened in 2000 and 2022. But you kind of, there are funds out there. If someone's got that appetite, if they believe in US big tech, then I'd say, right, buy the S&P 500 or even better, buy NASDAQ. And you'll get all the returns, but be careful because you get the losses as well. Remember, those big companies lost massive amounts in 2022. They just come steaming back in 2023.
So it's not the case that Courtiers has grown nil in the last year?
Not now, no. We're up. But the global fund is not yet up in the last year, but off the top of my head, all our other funds are up now year to date. So.
Okay.
The calendar year today and over the last year.
There's a similar question from Maureen, mentioning an international index tracker, returning 14.6% in the last year. And the US index trackers returned 16.9%. Again, the question asked from Maureen, why has the growth been negligible in the last year for Courtiers?
So the international index trackers tend to track the MSCI World Index, and that's made up of over 65% US. So it's dominated again by the big seven. So we don't track the MSCI World Index. We don't pile everything in there, because if we did, we would have a plus 60% weighting to the US. And when the top end of that US sector is it's dominated by big companies on very, very high multiples, we steer away from it, because what we're trying to do is have as smooth a ride as we can possibly give for our investors to meet their goals.
Sure.
The other thing is, just to be clear with this, is we don't get up in the morning looking at these indexes trying to beat them. We get up in the morning and we look at where we're going to get the best asset returns to deliver the client's objectives over a period. Now, we're a little bit more aggressive. If you want to invest pure equity, UK Equity Income Fund or global equity, our global equity income fund, excluding the UK, would be more aggressive because they're all equity. But the multi-asset funds are risk-controlled funds. And I just say again, they've got a fantastic track record. When you compare them with other multi-asset funds, we are top quartile, and we're right up there with risk-adjusted returns as well. That's why we got so many awards earlier in the year from Refinitiv.
So it's not about beating the trackers and the US market. It's not about beating. It's about meeting the client's objectives.
No,
as Maureen asks, should coaches invest proportionally more in such trackers?
No, I can't, because it would breach the risk limits. So you've got to. They are multi-asset funds, and I cannot swing. We cannot have so much swung into just one sector, and if somebody wants to just track the S&P 500, and if they're prepared to take the risk of paying the high PE ratios for it, particularly when the UK is significantly cheaper at the moment, then that's fine. But you've got to understand, when you do that, you get a whole load of risks associated with it. And over the long term, we've got an outstanding track record of delivering returns, above average returns for below average risk. But I'm not a magician. I can't deliver S&P 500 type returns at below average risk. It's just not possible. Sure. But if an investor wants the S&P 500, they can always go and buy those big techie stocks themselves and take the risks with it.
So we're flying around the world here. We've got a question from Janice, who listened to a Radio 4 programme on the global debt crisis, which highlighted India as a safer option for investment, having debt but having good growth prospects going forward. So Janice asks, what are your views on Indian stock markets? And similarly, Nick, India, highest population and growth projected for the next 30 years. Have you got any sights on that?
Yeah, I completely agree with them. I think India is a very, very exciting prospect. But if you remember, Leo, Jake covered this issue of which market would you have gone to in the late 90s? America with its low growth economy, or China with its high growth economy? If you'd have picked China over America, you'd have been a lot worse off in terms of investment returns. Now, India at the moment, we monitor all the fundamentals on the Indian market, comes up on the monthly asset management reports, and what you'll find is that the stock market is actually quite expensive. So because people see the prospects, they're paying above average for it. So, for example, you can buy the Brazilian market. Take last month on our fundamental analysis, so you go back to November, you could buy the Brazilian market on a multiple of 8 times. Indian market's about 20 times earnings, and that means it's about as expensive as the US market is now. But in terms of the economic issues, I completely agree. India is a genuine democracy. It's got good industry. It's leaning into IT, perhaps a bit more successfully than China has done within its economy, which China was very good at turning out low-cost manufactured items. India's lent more into service sector. I think it's very, very exciting as an economy for the next few decades.
Thank you, Gary. Jumping back to the coaches funds, interesting question from Harry. Should you be recommending money invested in the cautious fund be moved into another fund?
Well, fair point. The thing with it is, if you transfer the money from cautious to another fund and you're trying to get better return, so you switch it to balanced or growth, you immediately take your risk up. So if you look at the volatility of the funds over the last 10 years, cautious has been very stable and very low volatility. It does wobble. There's no guarantee that it will never go down. But it doesn't wobble as much as the other funds, and it doesn't wobble as much as the major equity indices. So I think you pay your money, you take your choice. It depends what your risk appetite is.
Sure. Nikki asks, she's interested to know your thoughts on the risks associated with an acceleration of climate change. And climate change is a hot topic throughout these questions. But in particular, Nikki says, insurance company stocks, when payouts look like they will become regular events.
That's a very good question from Nikki. What I would say is there's an immense amount that I think we all accept, the rational people accept, that you've got something happening with the climate. That's evidence is certain. How we solve the problem long term, I think, is not clear. We will solve it. I guess because we're closer to seeing what companies are doing than perhaps average members of the public. We know that pollution, carbon, ethics, management, sustainability is all being measured now. And once it's measured, you can manage it. Remember that old adage, if you don't measure it, you can't manage it. Well, it is getting measured. What I think is uncertain is where the solutions will come from. Will it be nuclear? Will it be more wind? Will we find something else? Will it be hydrogen? Will it be tidal? Or is there something else we've missed at the moment? What I would say with this is when you get the movement in technology, the shifts come very, very quick. And I'd invite people to think back to 2001, when the iPod came out. It seemed impossible you get 1,000 songs in your pocket. But then that got followed up with the iPhone. And now look what we carry around. 20 years on, we're carrying computers that are vastly, vastly more powerful than the original ones that came out decades ago in our pocket, on our wrist. And I think in the same way that technology can change faster than we can imagine, the way in which we solve the climate problems will change. And I think they're exciting times there, because I think you're going to get awful lot of technology, and I think in 50 years' time, our planet's going to start to be a lot cleaner in terms of the amount of pollution that we're pushing through it.
Well, Colin asks, given the research into green hydrogen production, how do you see the energy market reacting if large-scale production is achieved? Making the point also that hydrogen's non-geographic, so oil-producing nations will be affected badly.
Colin's spot on, which of course there's a vested interest in trying to keep oil flowing for as long as possible. But a very interesting chat with a client that runs a lot of very, very big commercial vehicles. And I know their view is that they actually say hydrogen will be used to move the vehicles, electricity will be used to move the parts on the vehicles. So there'll be almost like a hydrogen electric hybrid. And I think I think hydrogen may play a big part, which comes back to this issue with Tesla. If you're paying 70 times earnings for Tesla, which is a car company committed to electric cars, not hydrogen. So if hydrogen cars eventually take off and they win the day, Tesla's way behind on the technology, and that stock price will fall like a boulder.
Mm-hmm. So this goes some way to share your thoughts where Jeff asks, what does the next few years bring? And we can consider within that, I think, a few questions we've got revolving around politics. From Jackie, if Keir Starmer becomes next PM, what will be the reaction of the markets? From Matthew, Liz Truss, was she right or wrong? Several more here. John, Leaving Liz Truss aside, do governments in the UK make a difference to investments? So tell us what you think about what the politics is doing to markets and how the future of politics in the next 12 months might affect the markets.
Well, going into the next election will not be fought on the same ideological principles as the last one. You had Johnson and Corbyn. Starmer and Sunak are much closer. They are more middle of the road politicians. They're not on the extreme right or the extreme left. So I think the market looks at this, almost expects Starmer to be elected, bar Labour losing it. It's going to be a Labour government sometime, probably next year. I think that's fairly neutral. And then, do politics affect markets? Yes, they can do. I can assure you that if Jeremy Corbyn was ahead in the polls, the markets would be a lot more panicky than they are now, because he's fundamentally a left-wing Marxist, and there would be an argument over, he rehearses all the old arguments over nationalisation and the rest of it, and that. So politics can affect markets, but probably don't affect them as much as people think. And markets are remarkably resilient, irrespective of politics. Very often, these old companies have come through wars and changes in governments, and they keep going. Look at the survival of the German car manufacturers, despite what they went through during World War II and post World War II. So things go. There was a third question you asked me, Leo. What was that one?
Liz Truss, was she right or wrong?
Liz was. So I actually didn't think her policies were as bonkers as she seemed. Where she made a massive mistake was in not consulting with the Office of Budgetary Responsibility to have a look at what her changes and Kwarteng's changes would have done. And so the market panicked. And if you looked at Jeremy Hunt's last budget, he was at pains to point out that everything had been costed and forecast by the OBR. So much more astute politically. And Truss and Kwarteng were extremely naive.
So another from Nick, and Andrew, if I can bunch these together. From Nick, what are Court's views on experts pointing the way to 2024 being a crash year? And Andrew asks, will 2024 be the year that global sovereign indebtedness finally implodes?
Well, with regard to views of experts, I would refer to the Economist article of a few decades back called Rubbish In, Rubbish Out, when they took 4 groups of people, asked them to make a number of economic forecasts, and one group was the dustman, and the dustman won. So the experts, the economists and people are very, very rarely right. As Jake showed again during the seminar on Irving Fisher's forecast from the peak of the market in 1929.
Oh, and James's.
Yep. Sorry, James's. Stocks are okay at these levels, and then they crash. So you'll be amazed how often the experts that we see are paid for being seen and expressing views, and they'll knock them out 10 a penny. It's very different when you've got to make a decision on the money.
How can there be experts when the world's changing so rapidly anyway?
Well, Mervyn King always said, and I think he did a fantastic job at the Bank of England. They have to forecast, but they were always at pains to give a range of options. But Mervyn King says, if nobody knows, and if anybody tells you they do, they're a charlatan. And I think everyone should bear that in mind.
Something I learnt from Marie, and forgive me if I don't say this correctly, does the Kondratiev cycle still apply?
A Kondratiev cycle? That's a very interesting. I'm not a technical analyst, so I couldn't comment on that, Leo. But James, you might have to pick that up with James at a different stage. That's more his thing than mine.
No problem at all. And I think I'd like to pick this one up as well, to give us time to refer back to your December article, relating to which Chris has asked, can Gary explain Gordon's growth model per his December article?
So let me simplify Gordon's growth model the best way I possibly can, and it's this. Assume you've got a business that makes £1 million profit a year. If I pay 20 million for that business, I'm paying 20 times the profit, or in the parlance of the market, 20 times the earnings. So I'll get a certain return on that. But my return is going to be much better if I only pay 10 times earnings. Because if I pay 20 times, I'm going to get a 5% yield on my investment. If I pay 10 times, I can get a 10% yield. And that's all it is. The lower the price earnings ratio, the better chance you've got of making a higher return. Bear in mind that if you buy Tesla, you're paying 70 times earnings. You know, so it's going to take 70 years to give you your money back. That's all Gordon's growth model is there.
Thank you, Gary. Focusing on productivity, a question from John. Do we need to increase productivity with the UK or increase migration to cover the gap in the workforce?
I think we need to increase productivity. Whether we need more migrant workers or not, it depends on how the economy goes. But in a way, we have been using a lot of migrants to fill jobs, and companies have been more willing to employ cheap labour than they have been to invest in making goods or delivering services for less money. Because a worker can be laid off if things go well, but that 500,000 machine you've just bought and stuck in your production line, you've got it, whether you've got demand or not. So that's the thing with it, Leo. And but that's changing, and I think now we're going to get a shift towards productivity improvements, particularly because AI is going to be capable of delivering a lot of improvements in output.
Timothy asks whether you can comment on the Inflation Reduction Act and its impact on investment decisions.
Well, it is a bit of a badly named act, Inflation Reduction Act.
It is abbreviated.
Yeah. Well, it's because Biden introducing that has really opened the scope to subsidise specific industries, put a lot more government money into the economy, and he's doing it by calling it the Inflation Reduction Act. I can assure you, if Jay Powell, the chair of the Fed, had been honest, he must have put his head in his hands when he saw that come out and thought, I've got to get inflation down and deal with this at the same time. So, but their economy is doing really well. So it's doing some. It's probably more Keynesian than it is in the camp of sound money, but it's done a good job for the American economy.
What about the UK government? Have they got economic policy right? Should it continue in the same vein? And if not, what should change? All questions from Kathy.
Well, they haven't had economic policy right for a long time. And I'm not pointing a finger at the Cameron government that introduced austerity in 2010, but clearly in retrospect, that economic policy was dreadful because our rate of economic growth slowed down and we didn't get any improvements in productivity. So the average worker wasn't getting any better off under a Tory government and hasn't been for the last 13 years or so, really. So I think this government is ditched austerity. There's generally a recognition. I don't think the voting public will tolerate another spell of sound money and austerity. But I don't think anyone should worry about that, because I think the likelihood is in a different environment we're going to get productivity improvements, and I think that's going to be good. So hopefully the working person can look forward now to 10, 20 years of improved standard of living.
Thank you, Guy. I want to try and whiz through the rest of these now. Nick says S&P 500's recommended courses fund now showing some level of recovery. Is this because of expensive stocks? And mentions on your slides what happened after 2003 to 2023.
Oh, okay. Yeah. I think what he means there is that when I showed the Angus Madison data, going back a couple of thousand years in terms of output per head and productivity improvements, it cuts at 2003, 2002, 2003. Now, I didn't stitch the data together because Madison's using a certain method to do those calculations. I think I have respect for his data. I didn't do that. It just didn't seem right. But what I did put up in the presentation was a chart showing the flatlining of productivity output from 2008 onwards. So to answer that question, however, when the data come to an end of the early 2000s, we enter a period following the bursting of the tech bubble and then a global financial crisis of pretty static productivity improvements. And what we're all hoping is that we've got that 15, 20 year period out the way now and we're going to be on a different trajectory.
Looking a bit more specifically into stocks within the funds, Nick says makeup of equity fund with views on companies like Unity Software, cross-platform engine, Riot Platform, Marathon Digital, cryptocurrency mining, Hussein and Sports, Adidas, Hilton, etc.
Well, what we have targets for liquidity. So some of these stocks we couldn't sort of smaller liquid stocks we can't own. We take the view that if an investor is specifically interested in those, they will buy them themselves. Whereas what we have to be mindful of is trying to make sure that our fund is liquid and can trade. And if you get that wrong, you can get into a terrible mess. We had a recent example of that of Woodford's fund when he deviated in a lot of smaller stocks. And then when people wanted their money out, he couldn't realise the stocks to get the money out. So people won't see this in the day, but every week we're looking at liquidity. How long does it take us to liquidate a certain percentage of the portfolio? All these things are monitored. So we can't just get up in the morning and buy exactly what we want. It's got to be in accordance with the risk objectives and in accordance with the objectives for diversification and liquidity. So some of those stocks may be fabulous. There may be one out there, but what I would say for every Apple, for every Facebook, for every Google, there are hundreds and hundreds of businesses that failed at outset or in an early stage, and we're trying to avoid those.
Sure. Question from Derek. What impact do you think that a second Trump presidency will have on financial markets from 2025 to 29?
I think financial markets are sort of assuming that he may get in. I don't think financial markets particularly like Biden either, so it's kind of Hobson's choice. Interestingly, somebody explained it to me quite well recently, and when they said that anyone but Biden can beat Trump and anyone but Trump can beat Biden. So it's almost the parties have chosen their leaders that are not necessarily would be the choice of the average American, of the American people. But I don't know, Leo. I honestly don't know. But you tend to get an awful lot of spouting and talk from the politicians, and when they get into power, they can never do quite as much as they said they would do.
Charles mentions that the charts in the seminar presentation showed a decent percentage increase in cash, and asks how can this be with inflation at its current rate?
Well, the rate on cash now is up to about 5%. So cash has been, remember the rate's been going up recently. If you take the very long term, so if you look at the data we produce in the equity gilt study every year, cash barely keeps pace with inflation over 120 years. Nor do government bonds really. You get a small amount of increase in real returns, but it's not that much. And if you've been holding cash recently, you've been getting negative returns relative to inflation. Now, except you've had the same problem with your courtiers funds, but in the long run, we've knocked through real returns and cash hasn't.
When China borrows money, who or what does it borrow from? Asks Kathy.
Good one. Borrows a lot from its own people. So a lot of the debt, a lot of government debt comes from their own people. The corporations borrow a lot then from the government, and households borrow from the banks. So they're all borrowing from each other. But if you add it all together, Chinese debt's about 300% of GDP now. And the banks have got sort of approaching $500 billion US dollars in NPLs, non-performing loans, which are either defaulting on the interest or on capital repayment. So they're not in a good state.
A couple of questions relating to housing. Sailesh asks, has house price increase over the last 10 years beat Courtiers Growth Fund? And from Howard, does Courtiers invest in social housing in the UK?
We indirectly invest in social housing because some of the developments which are undertaken by the companies that we own, so your Barratt's, Taylor and Persimmons, would have a social housing element. We don't invest directly in it, although even companies like Legal & General that we hold, they have they've got a program for prefabricated housing. So even these financial businesses are looking at this as an opportunity. And with regard to Sailish's question on house price increases, they have been steadier than the returns from our funds, but housing is a real asset. And if you compare it in its absolute form then with our growth fund, for example, our growth fund beats house price increases easily. So it's been a better place to be than if you're relying on house price returns.
Jake mentioned Barclays as an attractive business. Yet Timothy asked at the Windsor seminar, why has Qatar sold Barclays shares?
Well, why in any time to get a share price where it is, you need willing buyers and willing sellers, and it's the equilibrium that it's the price in market theory that matches buyers with sellers. So I cannot remember off the top of my head why Qatar sold Barclays shares or when they did it, but they would have had their own reasons. If I remember rightly, there was a bit of a falling out between Barclays and some of the Arab states, and perhaps that was something to do with it. But Barclays share price wouldn't be depressed as it is if there weren't a lot of sellers. So whenever you buy an undervalued stock, you are taking a contra view to the majority that are selling it. But by doing that long run, you tend to pick up the companies that people don't want, whilst very often these buyers then move on to the things that are doing very well and they pay a premium for them.
Just staying on housing and households more specifically, Jason's asked, what are your thoughts on the distribution of wealth in the UK, the trend, the housing shortfall, and the potential impacts of these and other factors on the UK economy?
So I'd probably be a conservative liberal politically. I think that we are better off as a country if we do a bit more to help some levelling up and create opportunity. The problem you have with falling interest rates is that they boost asset prices. It's one of the effects. Bank of England knows this, and then what they hope is that people who've got boosted asset prices feel more confident, start doing things in the economy, spending a bit more money, and fire up the animal spirits that gets everything going again. The difficulty is if you haven't got assets, you fall behind. So yes, there is an increasing inequality. It's been very tough for the working class family to maintain their standard of living with high inflation, whereas the wealthy pensioners have had, me included, have had indexation, full indexation of their pension benefits, and have not taken anywhere near the same level of pain. So I think that for the next 10 years, and I dare say that our clients that, like me, are in their 60s or older, in their 70s, 80s, would actually be quite happy to give a little bit away, with the state not concentrating on them so much, in return for creating better opportunities for their grandchildren and great-grandchildren. And I think we owe it to them to do a bit more to boost productivity and allow these young families to get a foot on the property ladder and start to build their own assets and capital.
Thank you, Gary. We've got a question from Jerry about what analysis is done to determine the volume of investing in the emerging markets index. Would I be right thinking that's one for James?
Yes, but we do that work on a regular basis. We look at places like Brazil, Mexico, India, China still regarded as emerging, South Korea still regarding as emerging, although it's kind of nearly emerged. We do a lot of work on those markets. So we produce the fundamentals for them. Some of them on a regular basis, and then some at need. So we are mindful. But emerging markets have not had a great run. But China's been a pretty disastrous place to have been recently. And we take the view, if you can find great opportunity in developed markets where you've got good regulation and great liquidity, and you can trust the quotes, then why look beyond your own borders? Let me clarify though, Leah, we hold stocks in emerging markets.
Someone who's familiar with travelling around the world at least once a year, Santa Claus. So Tony asks, who is Santa Claus's mother and father? And who will take over if Santa retires?
So I guess that's probably a reference to some of the views made on continuity within courtiers, and that's a very good point. So Jamie and I determined a few years back that we were never going to look for an exit. That freakishly and without any real pre-planning, our children took interest in the things that we liked, in different disciplines, interestingly, covered all the bases, and then showed an interest in courtiers. I think if it hadn't been for that, we'd have probably thought we can't go on forever and there'd have been an exit route. But I'm actually really comfortable with this strategy, because I do think we owe it to our clients to provide certainty and continuity. I don't think it's very nice if somebody in their mid-80s suddenly finds that their advisor or wealth manager they've got to know over decades has sold and cleared off. I think we owe it to them to do the job for the long term. And I hope that courtiers is like Berenberg Bank, which is older than the Bank of England, still going with a great reputation in 400 years. Now, that's a tall ask. There's many a slip between cup and lip. And you can imagine many slips there are between cup and lip if you've got 4 centuries worth of them. But anyone who came into the seminars saw that you've got Dec is a very, very able long-term replacement for his father. Jake is a more than capable replacement for me, and they'll do a better job than Jamie and I have done, and I think that's exciting for the business. So there, I think if that's the question, if the question really is who is Santa Claus' mother and father, I do not know.
I think it's also, worth highlighting that you and Jamie and the family and employees do invest in the coaches' funds?
Oh yes, absolutely.
This was answered at the seminars, but
Yes.
it was a great point.
Yes. There's well, one, I believe in them. They do the job, and I kind of feel obliged to have spread out amongst all the funds. And two, what it means is I'm never distracted by my own investments. So there's nothing outside apart from having a bit of cash of rainy days and the house we live in. Everything I've got is in courtiers, either through the value of the half share in the business or in the funds. And so everything goes in my ISAs, pension, ordinary portfolios, all in the courtiers funds. And that means I never have to think about anything else apart our fund. I never have to spend any time running my own assets. I just have to worry about courtiers assets. And I think personally, from a fund management point of view, that removes any conflict of interest, and it's a much more comfortable way to approach life as a fund manager and as a wealth management business.
Makes sense. We'll close with a question from Mark. Will England struggle without Owen Farrell?
Well, Farrell's, he's not getting younger, is he? He's been at the top of his game for a long time. Done a fantastic job for Saracens, and he's done a very, very good job for England. But I think the tides are turning. There's a lot of good youngsters coming through in the English game now, and Marcus Smith performed extremely well in the World Cup. But any side is going to miss somebody like Owen Farrell. As a North London boy, I'm a Wasps supporter. They're bust now, which means I have no conflict with who I support on a Saturday because it's all Rams. But so I've never been a big Saracens fan by any means. But you can't help but respect somebody like Owen Farrell because he's been an absolutely outstanding servant to his club. He might do a few crazy things every now and then, but the commitment is beyond question. So yes, England will miss that, but Marcus Smith is an extraordinary talented 10, doing a great job for Harlequins, and he'll take the mantle on and be really good with it.
Gary, thank you for your time and your insights throughout the seminars and throughout this Q&A session. There's one more question from John regarding a survey that we sent out earlier in July this year. I can answer that one. Yes, we sent out a few questions to sort of obtain a snapshot of how we're doing. We received around 100 responses. Thank you very much for those. Around half of those were generally satisfied with everything Courtiers is doing, and we took a handful of comments and put those on record to move forward with. 2024 is going to be another year where we focus quite heavily on improving your experience. So thank you for that. Thank you for all your questions. Hopefully we've answered them all. If there are any more, just please speak to your advisor or contact us, and we'll do our best to get those to you. All that's left really to say, Gary, is we're approaching the end of the year. Do you have any final thoughts to share?
What I'd say, Leo, is we said at the seminar, these are some of the best opportunities we've seen for 20, 30 years in mainstream markets. So for us, we're really, really excited. And some of that potential has started to get realised from the end of October. Now, 2 swallows don't make a summer, and 2 good months don't make a decent Christmas. But it's sort of a start. So I think that's very, very exciting. I think there's a lot of really exciting things happen, and a lot of very knowledgeable clients send in those questions. They're recognising the importance of climate change, the discrepancies in markets. You get really great questions. So I think for us, it was great seeing everybody through the seminars, and I think we had well over 300 clients turn out, which was fantastic. And I'd like to wish them and everybody else a great Christmas, and let's hope it's a very peaceful and extremely prosperous 2024.
Thank you, Gary. Season's greetings from courtiers, and we look forward to working with you in 2024.